The manipulators waited until the bitter end. Thin volume, books closing, no liquidity. Then on the final trading day, they pulled the rug. If you checked the screen today, you didn't see a correction. You saw a sea of crimson. Silver crashing from the highs. Gains wiped out in hours. Faith shaken just before the year turns. For stackers, it felt personal. You held through the volatility. You believed the breakout was real. Now, right before New Year's, your portfolio bleeds. But here is the truth most stackers miss in moments like this. This isn't the end of a bull run. It is not a failure of fundamentals. It is a forced liquidity event, a mechanical sell-off driven by rules, not reality, a dash for cash that happens yearly, hurting only those blind to the game. Dec 31st is not a trading day for the banks. It is an accounting day. At midnight, regulators take a snapshot of every major balance sheet. That snapshot sets capital requirements, risk scores, and penalties for the next year. Hold too many volatile assets and the cost is billions. The fix is simple. Sell everything: gold, silver, stocks, bonds. Convert risk into fiat cash. Cash lowers the score. Cash keeps regulators quiet. So when you see huge red candles in a thin holiday market, don't mistake it for panic. This isn't investors losing faith. This is banks cleaning their books, dumping positions into low liquidity to window dress the balance sheets one last time. It feels violent because it is concentrated. It feels unfair because it really is. This is the final tamp down, the last shakeout before the reset. And if you know what's happening, it is not a reason to fear. It is a signal. A signal that the pressure is temporary, the trend is intact, and the big setup for January is already in motion. Don't let them steal all your ounces. If this intel helps you stay calm while others panic, hit 1 in the comments. If you want the real truth on market moves like this, subscribe now so you don't miss what comes next. To get why silver tanked today, you must step inside the mind of a banker on December 31st. This isn't a day driven by conviction forecasts or long-term strategy. It is driven by fear of numbers on a spreadsheet. At midnight, regulators freeze the frame. Whatever assets are on the books at that exact moment define the bank's risk profile for the entire year ahead. This single snapshot sets capital buffers, systemic risk classifications, and regulatory penalties. If a bank is holding volatile assets when that picture is taken, its risk score rises. When that score rises, the punishment is immediate and brutal. More capital must be set aside. Less leverage is allowed. Profits are reduced. Careers are questionable. So the decision is not philosophical. It is mechanical. You sell first and ask questions later. Precious metals are among the first to go, not because they are weak, but because they are liquid. Gold and silver can be converted to fiat instantly. Cash is the only asset that lowers risk scores without questions. That's why silver, gold, bonds, and equities all fall together in moments like this. It is not a judgment on value. It is a scramble for a balance sheet survival. Banks aren't trading. They are evacuating. And they are doing it in the thinnest market of the year when every sell order carries exaggerated force. This is why the move feels outsized. A few thousand contracts sold into a holiday market can move price levels that normally take weeks. Algos amplify the move, stops get triggered, momentum traders exit. What began as accounting turns into apparent chaos on the chart. But this chaos has a clock. Once midnight passes, the rule no longer applies. The snapshot is taken. The pressure lifts. The same institutions that sold to survive December are free to buy again in January. This is why these crashes feel sudden, violent, and confusing. They aren't organic. They are scheduled tamps. You aren't watching a market decide silver's future. You're watching banks survive a deadline, and deadlines expire. Look at the broader picture, and the message becomes clearer. This was never just about silver. Gold dropped hard, too. And when gold sneezes, silver doesn't just catch a cold, it bleeds. Silver is a smaller, thinner, more volatile market. It amplifies whatever force moves gold. A 2% move in gold can translate into an 8% swing in silver without warning. That link matters. It tells us this isn't a supply story. It is not about demand suddenly vanishing. It is a macro liquidity event, a synchronized sell-off across asset classes driven by one thing: the US dollar. When banks sell assets to raise cash, demand for dollars spikes, not because the economy is strong, but because the system needs dollars immediately to satisfy year-end requirements. This artificial dollar shortage drives the dollar higher, and a rising dollar acts like a wrecking ball. It crushes everything priced in it. Commodities fall, metals fall, risk assets wobble. But liquidity crises are by nature temporary. The system cannot function without dollars. The central bank knows this. When the strain becomes visible, liquidity is injected. Repo markets open. Pressure eases. The dollar retreats, and when the dollar retreats, the metals rebound with force. Right now, you are in the eye of that liquidity storm. It feels violent because it is fast. But fast moves driven by funding stress rarely persist. They reverse when cash becomes available. This is why gold and the silver move in lockstep today. It confirms the cause. It also hints at the resolution. When liquidity returns, both markets recover. Silver doesn't need a new narrative to rise. It simply needs the dollar to exhale. The trend didn't change today. The environment did. And environments shift far faster than fundamentals do. Now let's talk about what everyone is staring at in disbelief, the chart. A sudden drop to the low 70s is not pretty. It breaks the short-term uptrend. It prints a massive red candle that dominates the daily chart. To technical traders, this looks like failure. To algos, it looks like momentum. And to those who trade signals, without context, it screams one word: sell. This is how secondary damage is created. The initial selling was mechanical, but what followed was emotional and automated. Stops were hit. Trend followers exited. Short-term models flipped bearish. Each layer of selling fed the next. The move fed on itself. Right now, price is testing a critical zone. This level was resistance for weeks. The ceiling that price couldn't break. Once broken, it must become support. This is the line in the sand. If it holds, this entire collapse becomes a backtest of the breakout. Painful, yes. Invalidating, no. And here's the detail most people miss. Look at the behavior near the lows. Each time price dips into this zone, volume spikes. That is absorption. Someone is stepping in front of the selling. Someone is saying, I will take it here. That someone isn't panicking. That someone is positioning. This is how bear traps are built. Weak hands see a broken chart and sell in fear. Strong hands see discounted price and buy with patience. The market uses technical damage to transfer assets from emotional traders to disciplined ones. This doesn't mean price can't dip further. It means downside is being contested, not abandoned. Support is being tested, not surrendered. If this level holds, the chart heals faster than most expect, and the candle that scared everyone out will become the launch pad no one believed in at the bottom. Now step away from the screen, because this is where the real story reveals itself. While the paper price of silver collapsed in a matter of hours, the physical market barely flinched. Dealers did not rush to cut prices. They didn't flood the market with inventory. In fact, the opposite happened. Premiums expanded, availability tightened. The street price refused to follow the screen price. This disconnect isn't an accident, it is a signal. If this crash reflected true weakness, if silver had genuinely lost value overnight, physical sellers would be panicking, coin shops would be flooded with metal, dealers would be slashing premiums just to move product. That didn't happen. Instead, premiums widened because dealers get replacement risk. They know that selling metal cheaply today could mean they cannot replace it tomorrow when the price snaps back higher. This behavior tells you everything. The selling you see is confined to paper markets, leverage, and contracts that can be exited with a keystroke. The physical market requires commitment, storage, transport, capital, and the physical market is not voting bearish. Trust the market that demands delivery, not the one that settles in cash. Paper traders are emotional, stackers are deliberate, and right now physical holders are not selling. Now look at the industrial side. If you are a manufacturer planning production for the year ahead, today isn't chaos, it is opportunity. Lower spot prices reduce input costs. Industrial buyers do not chase momentum, they accumulate value. Their bids create an invisible floor beneath the paper. This is how shortages accelerate. Metal leaves vaults and enters factories. Once consumed, it never returns. While paper traders dump contracts, real silver is being absorbed quietly and forever. The chart may look broken, sentiment may feel fragile, but underneath the noise, silver is migrating from weak hands to strong ones. And that transfer is exactly how the next explosive move builds. While most stackers focus on the red candles visible on the paper chart, the most critical move today is churning beneath the surface level. To tamp the metal down this violently into the year-end, the cartel likely had to reshort the COMEX aggressively. They didn't just dump old longs. They printed new paper supply. They opened fresh shorts into the smash to fake liquidity when absolutely none existed. This paper detail matters far more than spot price does. Early in the week, many swap dealers had reduced their net shorts. They covered into the rally. They lightened loads as silver spiked higher. But to tamp spot before the regulatory snapshot, they had to step right back into the fire. New, naked shorts were deployed not because the metal is weak, but because they needed a tamp down immediately. This wasn't confidence. It was necessity. And necessity creates bear traps. Every paper ounce sold today becomes a future obligation. Shorts don't vanish when the calendar flips. They stay open waiting to be covered, and when volume returns, waiting becomes very costly. By tamping spot down now, the cartel bought temporary accounting relief at the direct cost of future pain. This is how volatility compounds. One forced event sets the strict stage for the next. By reloading shorts into a market where physical supply is already tight, they are stacking fuel for a violent reversal. When stacking pressure returns in January, these shorts will have to compete for limited liquidity. That competition is called a short squeeze. And the exit door is smaller than before. Industrial demand has not slowed down. Physical vault stock has not grown. Ape conviction has not disappeared. The real metal sold today is harder to source tomorrow. They kicked the can forward, but they kicked it uphill. Time, math, and scarcity are not on their side. Real gravity always wins. This is where the calendar finally shifts in your favor. January is not just a psychological reset. It is a structural reset for fiat flows. On the first trading days of the new year, fresh fiat enters the system automatically. Big pension funds deploy new allocations. Endowments rebalance portfolios. Retirement accounts receive steady inflows. Billions of dollars that were sidelined in December return almost all at once today. Right now, the market feels hollow because it is. Liquidity has been drained by regulatory pressure, tax loss selling, and risk reduction ahead of year-end. That absence of buyers is what allowed spot prices to fall so fast. But emptiness cuts both ways now. Once January begins, the sellers disappear. The accounting snapshot is done. The tax year is closed. The artificial reasons to sell evaporate overnight. The same bullion banks that dumped assets to survive December are suddenly free to rebuild positions. And they return to a paper market that has been pushed unnaturally low. This creates a vacuum in the market. Buyers must raise bids to attract sellers. That is why January reversals are often sharp and emotional. The speed of the rebound frequently mirrors the violence of the tamp that preceded it. Silver does not need a new bullish story to moon. It simply needs fiat capital to return. And that return is mostly scheduled. This is the slingshot effect. The deeper the pullback, the more energy is stored for the launch. By forcing spot lower into the year-end, the system compressed the coil spring. When it releases, price can travel further and faster than anyone expects. Selling now is not risk management. It is capitulation at the worst possible moment. You are exiting just as structural headwinds turn into tailwinds. January is not about hope. It is about mechanics. And the mechanics reward real patience. Now let's talk about the emotion driving the final leg of this move, because markets don't bottom on logic. They bottom on exhaustion. What you are seeing right now is not just selling. It is capitulation. Stackers aren't making calculated decisions. They are reacting to pain. They are selling because the tamp feels unfair, because the drop speed feels unnatural, because confidence has been shaken. This emotional washout is totally necessary. When spot falls hard and fast, the first wave of sellers is mechanical. Stops are triggered. Algorithms respond. But the final wave is human. It is the moment when stackers throw their hands up and say the game is rigged. That anger is not a warning sign. It is a clear buy signal. Markets tend to bottom when frustration replaces optimism. When hope is gone, selling pressure dries up completely. There is no one left to panic. That is when the spot stabilizes. Look closely at sentiment. Comment sections are filled with disbelief, accusations of rigid manipulation, declarations that silver will never moon. This is not the voice of a top. This is the sound of emotional capital being drained. And here is the paradox. The more convinced people become that spot cannot recover, the more likely a recovery becomes. Markets exist to inflict maximum pain. Today they punish the strong longs. Tomorrow they will punish the shorts. This is how false bottoms form now. Price pauses. Confidence vanishes, and then the reversal begins without warning. Those who sold for emotional relief watch from the sidelines as spot climbs back up without them. Fear feels like information, but it is surely not. It is a response to volatility, and volatility is highest at turning points now. The question now is no longer whether silver will recover, but how that recovery unfolds and who will still be stacking when it happens. Recoveries are shaped by cause, not emotion. And because this sell-off was driven by calendar pressure, regulatory mechanics, and forced liquidity, not by a collapse in value, the rebound is likely to be fast, sharp, and deeply unsettling. This is the classic anatomy of a V-shaped recovery pattern. When the calendar turns, forced sellers disappear almost instantly. The regulatory snapshot is complete. The tax year is closed up. The artificial reasons to sell are gone. Liquidity begins to flow back into the system again. What remains is a market that has been pushed below equilibrium with very few natural sellers left standing. In that environment, even moderate buying pressure can move spot far more than logic would suggest. The first signal to watch is the market open. A gap higher on strong volume is not random, it is confirmation. It tells you that buyers are willing to pay higher premiums to re-enter positions they were forced out of days earlier. That move often feels sudden because it is. Markets do not ease their way out of forced selling. They snap back. After the initial rebound, consolidation usually follows. Spot may move sideways as the market repairs technical damage. This is not weakness, it is construction. Sideways action allows emotions to cool short positions, to reassess risk, and momentum to reset. It builds the strong base for the next big impulse. Then acceleration begins. Shorts start covering up. Institutions rebuild exposure. Momentum traders return once key levels are reclaimed. Each wave of participation reinforces the next. What felt broken just days earlier suddenly feels inevitable now. The most dangerous mistake at this stage is waiting for comfort. Comfort only arrives after spot has already moved up. Recoveries do not reward certainty. They reward conviction when clarity is scarce today. We have reached the final chapter, and this is where perspective matters most. What you just lived through was not a failure of the thesis. It was a test of it. The year-end flush was a mechanical event designed to protect bank balance sheets, not to reveal truth. And those moments are always the most emotionally expensive because they force you to choose between fear and true understanding. Here is the main strategic takeaway. Markets are not moved by fairness. They are moved by incentives, rules, and timing. When you understand those forces, volatility stops looking random and starts looking useful. This crash was not an ambush, it was a scheduled transfer. Assets moved from weak hands to strong diamond ones. That is how long-term trends survive short-term violence. The lesson is simple but difficult. Spot price is not value. Liquidity is not demand, and pain is not proof you are wrong. The market will always try to convince you to abandon the stack just before it rewards it. That is not a flaw in the system. That is the system itself. Now, the strategy going forward is discipline. Watch the market open. Respect the levels. Let confirmation come to you instead of chasing headlines. If you hold physical metal, your job is patience. If you hold fiat, your job is preparation. Volatility creates opportunity, but only for those who are emotionally steady enough to act when others freeze. And finally, the verdict. This crash did not weaken the bull case. It strengthened it. It reset sentiment. It reloaded shorts. It compressed the spring. It gave the next leg higher, a stronger foundation. The fundamentals did not change. The national debt did not disappear. The scarcity did not resolve. Only the spot moved, and it moved for reasons that expire with the calendar. You made it through the noise that already puts you ahead of most folks. If this analysis helped you think clearly when the market tried to scare you out like this video so more stackers can see it, if you want calm, rational breakdowns when volatility hits hard, subscribe to the channel and turn on all notifications. And most importantly, share your stacker thoughts in the comments. Press 1 if you held through the storm. Press 2 if you are preparing for the next big move. Stay patient, stay strategic. The next chapter of this bull market is just beginning.